A debate has been intensifying since the start of this year. This debate surrounds inflation. A pickup in inflation is widely anticipated in Australia. Why? There is pent-up demand after lockdowns and stringent social distancing restrictions last year. There is also the massive spending by governments and the prevailing very low rates of interest in the economy. To put simply, the debate focuses on whether this pickup in inflation is temporary or permanent. The bulk of economists, including ourselves, think the lift will be transitory, and policymakers will look through this increase when setting policy. This week, fresh inflation data was published for the March quarter. We thought the inflation dragon might begin to stir from its slumber, if only temporarily, but lethargy continued to afflict the dragon. The widely anticipated lift in inflationary pressures failed to materialise in a meaningful way. Indeed, consumer prices rose by 0.6% in the March quarter, well under market expectations. Annual growth was 1.1%, which is well below the Reserve Bank's 2 to 3% inflation target band. Underlying inflation was also soggy. The trimmed mean measure of underlying inflation rose only 0.3% in the quarter and also grew at a 1.1% annual rate, the lowest annual pace on record. The inflation dragon is set to stir in the June quarter, with base effects from last year's falls in consumer prices feeding through to the CPI. Moreover, there's the expiry of some government support schemes, such as home builder and utilities rebates, which should cause a notable lift in price pressures next quarter. However, we expect this lift will be temporary. We spend a lot of time working out the trajectory of inflation because it is an important driver of the RBA's cash rate lever and other policies deployed by the Reserve Bank. The discussion around inflation will continue. As it continues, it is important to keep in mind that the Reserve Bank is focused on actual inflation. It made this pivot last year. In speeches and statements this year, the RBA has been at pains to stress actual inflation needs to move sustainably into the RBA's 2 to 3% target range before they will raise the cash rate. For this to happen, wages need to grow at a much faster clip in the economy. Employment has fallen faster than widely anticipated. So much so, we expect the unemployment rate to be at 5% by the end of this year and have a 4 in front of it by the end of 2022. The momentum in the labour market means the spare capacity in the labour market will be reduced over this year and next year, but it will not be erased. The RBA now believes the rate of unemployment, consistent with full employment, is somewhere between the high 3s to low 4s. It means the unemployment rate needs to fall to around this level before significant wage pressures can build. The bottom line is that the RBA is still a long way off from lifting the cash rate.